Hi, we are group 3 and my name is Nina. We are from minor blockchain, AI, and quantum. Today we are going to present our portfolio on decentralized finance, also known as DeFi. To start with, DeFi refers to a financial system built on blockchain technology that removes the need for traditional intermediaries like banks or brokers. Instead, it allows people to access financial services such as lending, borrowing, trading, and investing directly through decentralized platforms. The main idea behind DeFi is to create a more open, transparent, and accessible financial system for everyone. In recent years, DeFi has grown rapidly and has become one of the most important innovations in the blockchain space. However, while it offers many opportunities, it also comes with risks and challenges that we will explore in this presentation. And in the presentation, we will first provide an overview of the DeFi ecosystem and the key technologies that make it possible. Then we will look at its main use cases and real-world case studies. After that, we will discuss the challenges and risks, followed by current market trends and a SWOT analysis to evaluate its strengths and weaknesses. Finally, we will conclude with our overall insights and recommendations for the future development of DeFi. Now I will hand over to my teammate who will continue with the DeFi ecosystem overview.
The DeFi ecosystem is a connected system of financial service on blockchain. It allows users to trade, lead, borrow, and manage assets without banks or traditional intermediaries. Instead of relying on institutions, DeFi use smart contracts to run the service automatically. What makes DeFi different is that everything is connected. Different platform, users, and assets work together in one system. For example, a user can hold stablecoins, lead them on one platform, borrow another token, and then trade it somewhere else. This shows that the DeFi is not just one app, but a full ecosystem of connected services. And also, the DeFi ecosystem has several key components that work together. First, decentralized exchange or DEXs allow users to trade tokens directly without a central company. Second, lending and borrowing platform let users access liquidity without selling their assets. Stablecoins are also very important. They reduce price volatility and make trading and lending more stable. Another key part is the liquidity pools, where users provide assets and earn rewards like fee or interest. All these parts are connected and depend on each other, which makes the system flexible and innovative. Smart contracts are the core technology behind DeFi. They are programs stored on the blockchain that run automatically where certain conditions are met. They replace many roles of banks by executing transactions directly and transparently. This makes the system more open, but it also means everything depends on the code working correctly. Another key technology is Automated Market Makers, or AIMS. AIMS allows users to trade without order books or traditional exchanges. Instead, they use liquidity pools and a simple formula to set price. This makes trading easier, faster, and more accessible for everyone. Even though DeFi is powerful, it still has technical challenges. Ethereum, which is the main network for DeFi, can become slow and expensive when many users use it at the same time. This is called a scalability problem. When fees are high, it becomes difficult for users to trade or use DeFi services efficiently. To solve this, Layer 2 solutions are used. Layer 2 process transactions outside the main blockchain and then record the result on ethereums. This reduces costs and makes transactions faster. Because of this, Layer 2 is very important for the future growth of DeFi. And this slide shows recent activity on the Ethereum's network. We can see a high number of active users and transactions in just 24 hours. This tells us that DeFi is already widely used and has strong reward activity. At the same time, this high activity also creates pressure on the network. More users mean more transactions, and this leads to higher fees and slower processing. This supports the idea that scalability solutions like Layer 2 are necessary. It also shows that DeFi is growing fast and becoming an important part of financial system. So we can see that DeFi is not only a theory, but also widely used in practice. Now we will look at how people actually use these technologies in real situation.
In this part, I will talk about the use case of DeFi. DeFi is a special type of finance where platforms operate on the blockchain and rely heavily on smart contracts to function. A blockchain is again a system where information is stored across many computers. It is a shared ledger that contains all recorded information that is very difficult to change or fake, mostly because it is a shared ledger, making it also very transparent because everyone can see the ledger and any changes that were made to it can be seen. Smart contracts ensure both transparency and optimization. They are transparent because the code that make it function is visible to everyone, although it can be long and complex and therefore difficult to understand. Uh, they are visible. They are automatic because they follow an if this and then that logic, meaning they automatically execute actions when certain conditions are met. Once deployed, these smart contracts are usually immutable, so they cannot easily be changed, meaning they must be carefully designed before launch. This immutability also helps against tampering when the smart contracts are in use. The goal of DEFI is mainly to remove intermediaries, automate processes, increase transparency, and improve accessibility. These systems normally use cryptocurrency, also called coins or tokens, to function. Now I will briefly go to several DEFI use cases like stablecoins, decentralized exchanges, lending and borrowing, yield farming, derivatives, NFTs, gambling and prediction markets, and pay-to-earn games. First, the stablecoins. Stablecoins are cryptocurrencies whose value is linked to something external. Most of the time, fiat currency like the US dollar or the euro. This makes them more stable compared to regular cryptocurrency, whose value can fluctuate a lot. For example, USDC has a one-to-one ratio with the US dollar because it runs on the blockchain. Taxation can be done globally, often faster and at a lower cost since fewer intermediaries are involved. This is especially useful for offshore transactions, which normally take longer and cost more to traditional systems. Second are the decentralized exchanges. A decentralized exchange is a blockchain based platform where users can swap digital assets directly with one another. Without a central intermediary like a bank, it uses smart contracts and liquidity pools to function. Liquidity providers are needed to deposit tokens into these pools to make it work. These providers earn from fees when other traders trade. Platforms like Uniswap also use an automated market maker, which determines the price based on the supply and the demand within a pool. So basically, the more of a token in the pool, the lower its relative value is in that pool. Third, we have lending and borrowing. DEFI lending and borrowing work similar to traditional credit markets. Users can lend crypto to earn interest or borrow crypto by providing collateral. Protocols like Aave manage this automatically to smart contracts, which handle deposits, loans, and interest rates. If the value of collateral drops too much, the system can liquidate it to repay the loan and charge a penalty to the borrower. This removes the need for banks while still maintaining a structured system where risk is managed automatically. Fourth, we can talk about yield farming. Yield farming is a strategy where users actively move their crypto assets across multiple DeFi platforms to maximize profits. These users act as liquidity providers and earn rewards such as interest fees, trading fees, and additional tokens. Protocols like Yearn Finance automate the process of allocating funds to the best available strategies. Users deposit assets into a vault, and the smart contracts manage the investments. However, this comes with risks such as market change, smart contract bugs, or strategies that underperform. A fifth thing that we can discuss are derivatives. In DeFi, derivatives are financial contracts whose value is derived from an underlying asset like Bitcoin or Ether. Instead of owning the asset, users speculate on its price movements. A platform like DYDX allow users to take positions, either expecting price to go up or go down. If their prediction is correct, they make a profit, but if they are wrong, they can lose their collateral. So this type of use cases can sometimes be risky. Next, we have gambling and prediction markets. These platforms allow users to bet on outcomes of future events, like such as elections or sport matches or something completely different. An example is a poly market. Users buy shares representing outcomes, either yes or no, and the price of those shares reflects how likely the outcome is to happen. When the result is decided, winning shares gain value and the losing share becomes worthless. So also sometimes risky. Another use case is NFTs. NFTs or non-fungible tokens are unique tokens that represent ownership of a digital assets. Unlike cryptocurrencies, they are not interchangeable because each NFT has its own value. They often get traded on platforms like OpenSea. While NFTs aren't DeFi, they can interact with DeFi systems. For example, by being used as collateral in lending protocols or other blockchain-based financial services. Finally, we also have play-to-earn games. These are blockchain-based games where players can earn digital assets like tokens or NFTs by playing. An example is Axie Infinity. While these games are not purely DeFi, they use similar technology such as smart contracts and blockchain-based ownership to manage the in-game economies and assets. To conclude, DeFi includes a wide range of use cases from stable payments and trading to lending, investing, and even gaming. The main idea behind all these is to move intermediaries, automate financial processes, and make system more transparent and accessible.
Okay, so following the previous section, I will now present the current market trends in DeFi. In 2026, DeFi has moved beyond being a speculative crypto trend and is increasingly becoming a financial infrastructure layer built mainly on Ethereum. The focus is shifting from short-term speculation to more stable and practical financial use cases. One important indicator is total value locked, or TVL, which is currently estimated at around $130 to $140 billion. This shows that after the market downturn following events like FTX, DeFi has recovered and is now growing in a more stable and utility-driven way, rather than purely hype-based cycles. And for the major trend is stablecoins and lending. Stablecoins like USDC and DAI provide price stability and are essential for most DeFi activity. Lending platforms such as Aave and Compound allows users to earn interest or borrow funds without selling their assets. However, most loans are over-collateralized, which reduces risk but also shows that DeFi credit markets are still less efficient than traditional finance. And another key development is real-world asset tokenization. This means traditional assets like bonds, real estate, and investment funds are being brought onto the blockchain. This helps connect DeFi to the real economy and provides more stable returns and diversified investment opportunities. Finally, decentralized exchanges and perpetual futures trading continue to play a major role. Platforms like Uniswap use automated market makers to enable trading without intermediaries, while perpetual contracts have become one of the main drivers of trading volume in DeFi. Overall, these changes show that DeFi is becoming more mature, more regulated in behavior, and more integrated with traditional financial systems.
Alright, so now I'm going to be talking about the SWOT analysis of DeFi and then move on to the advantages and risks. Starting with the strengths. One of the biggest benefits of DeFi is that it removes intermediaries like banks. This makes transactions first faster, cheaper, and more efficient, especially when sending money across countries. It also gives users full control over their money because they store it in their own digital wallets instead of relying on a bank. Another strong point is accessibility. Anyone with internet connection can use DeFi, which means more people around the world can access financial services even if they don't have a bank account. Transparency is also important because all transactions are recorded on the blockchain itself, which can then be checked by anyone. On top of that, DeFi is growing very fast with new platforms and ideas constantly being developed. However, there are also weaknesses. One big issue is that smart contracts can have bugs, which hackers can then take advantage of, which can then lead to people losing money. DeFi can also be difficult to use, especially for beginners, because you need to understand things like wallets and private keys. Another weakness is the lack of regulation. While this allows more freedom, it also means there is less protection if anything goes wrong. Also, platforms like Ethereum can sometimes get overloaded, which leads to slow transactions and higher fees. Now looking at the opportunities. DeFi has the potential to give financial access to people who don't have it right now, especially in developing countries. There's also growing interest from banks and big financial companies, which could lead to systems that combine both DeFi and traditional finance. New developments like digital assets and decentralized organizations can also help DeFi grow even more and create new ways to earn or manage money. At the same time, there are also threats. Governments are still figuring out how to regulate DeFi, and stricter rules could slow it down. Security is another big concern since hackers often target these platforms. The value of cryptocurrency can also change a lot, which affects DeFi directly. On top of that, scams and fake projects can reduce trust, especially for new users. Also, traditional finance platforms can compete by being easier to use and more secure. Alright, so now moving on to the advantages and risk of DeFi. The advantages of DeFi include faster and cheaper transactions, especially compared to traditional banks. It also gives users full control over their money. Alongside this, DeFi is easy to access since you only need the internet, and is transparent because everything is recorded on the blockchain. Finally, it also encourages new ideas and innovation. However, the risks are also important to consider. Security being a big one, because hacks can lead to permanent loss of money. There is also little protection for users because of limited regulation. DeFi can be complicated, which increases the chance of making mistakes like losing access to your wallet. In addition, price changes in crypto and scams and technical issues like high fees can make DeFi risky. To conclude, DeFi has a lot of potential to improve the financial system, but it also comes with serious risks.
So to conclude, DeFi has developed from a niche blockchain innovation to a more mature financial ecosystem. It is increasingly focused on real financial use cases such as lending, stablecoins, and real-world asset tokenization. However, while DeFi offers benefits like transparency, accessibility, and innovation, it still faces key challenges, especially in terms of security risk, regulation, and efficiency compared to traditional finance. So, based on our analysis, we recommended improving smart contract security, developing clearer regulatory frameworks, and enhancing user experience to support wider adoption. In addition, stronger collaboration between DeFi and traditional financial systems could help improve stability and trust. Overall, DeFi is not a replacement of traditional finance, but a complementary system that has strong potential to shape the future of global financial markets. Thank you very much for listening.